Hello, this is Rick Cortez. I'm co-CEO of Broadmark Asset Management, and this is our monthly update on the Westwood Broadmark Tactical Growth Strategy. Well, so far this year, the S&P 500, at least at its high, was up 9%, and it retraced one half of last year's 18% decline. Part of the reason for the strength this year has been the economy continues to grow. It's slowing, but it continues to grow. And consumer and retail areas have been robust. Let's remember that the unemployment rate is still at its lowest level since 1969. The market seems to be, or at least has been, either ignoring or looking past the fact that we've seen the second largest bank failure in American history in the last week and 3 bank failures in the last month, and we have a looming debt crisis. The question that we are asked most frequently is, did we see the lows last October? Are we in a new bull market? Should we be buying? Or is this a bear market rally? Well, in order to answer those questions, let's turn to our 4-pillar investment process. The first pillar of our process is equity valuations. Valuations are high. The market is overvalued. The S&P 500 median PE today is 24 times earnings, which is above the 17.5 times earnings that's the average over the last 60 years. So we are 25 to 30% above fair value. And if we adjust for inflation, we're still in the same position because inflation has come down from 6 to 8% to 3 to 5%, but is still not at the 2% level that Chairman Powell would like to see us at. We believe that valuations are still high. It would be very rare that the market would see its final bottom before returning to fair value or undervalued. So we would have to say that valuations now are negative. The second pillar of our investment process is monetary policy and credit conditions. Don't fight the Fed. The Fed is in a tightening cycle, and the easing cycle doesn't begin until the Fed actually cuts rates. Since 1928, there have been 14 tightening cycles. Yes, indeed, on average, the market does rally following the final rate hike. It rallies about 2 months, up 5%. But in the 6-month and 12-month periods following the final rate hike, the market has been lower in both periods more than half of the time. So we are not out of the woods yet, even if we see the final hike shortly. And when we combine this with the inverted yield curve, which has an astounding record of predicting potential recessions, we'd have to conclude that monetary policy and credit conditions are negative. The third pillar of our investment process is investor sentiment. And here I can say that it's very neutral. Beware of the crowd at extremes. We do not have any extremes yet. The market's up 9%, but nobody seems to be bullish. A lot of people are bearish, but they haven't thrown in the towel. That may change, but right now that's neutral. So if we take a look at the first 3 pillars of our process, they're decidedly negative. The fourth pillar of our investment process is momentum. Momentum acts as a check on the fundamentals. As we all know, the fundamentals can say one thing and the market does another. So the momentum is a check on what the fundamentals are saying. So far this year, the market is up 9%, and breadth has been reasonably good, and our breadth model has been positive. But this has not been confirmed by volume. So far this year, supply has exceeded demand in terms of volume, and breadth is getting weaker. Here are 2 facts. Number 1, 10 stocks in the S&P 500 have accounted for 86% of its rise this year. And number 2, the S&P 500 is a cap-weighted index. It's up 9%. The S&P equal weighted index is up only 3%. So momentum is at best neutral, but leaning negative. Our positioning right now in our separately managed accounts is that we have 75% of assets allocated to cash and cash equivalents. Since we don't own individual securities, we invest in ETFs, and we usually use the ETF BIL, that is the 1 to 3 month treasuries, for that investment in treasury bills. The 13-week treasury bill as of May 1st was yielding 5.27%. With the remaining 25% of our clients' separately managed accounts, we are in a large ETF, large cap ETF that's very diversified. So we are very cautious on the market right now. We would raise our market exposure if interest rates declined, if investor sentiment got more pessimistic, which is good from a contrary point of view, and most importantly, if our volume and breadth models improved. We would decrease our market exposure if interest rates rose, and particularly if credit spreads started to widen. And that's something to watch in the next month or so. And if our breadth model dropped into negative territory and our volume model was in negative territory, that would trigger our risk management process, which would require us to go 100% to cash equivalents, or in short-term treasuries. It's at that point that our investment team would get together and say, should we take some short positions in this market? Why would we take short positions? Well, the reason is that we're an absolute return manager. Our goal is to make money every year, to achieve positive returns every year. We've done so in 17 of the last 22 years. We've never had a decline of more than 8.5% high to low. And we showed positive returns in 2008 and 2002 during those bear markets, in part because we used short positions. We do not predict the market. My partners and I have been around for decades, longer than we like to think. We've seen many, many markets, and we know we cannot predict the market. That's why we have a 4-pillar process. So the answer to the question, are we in a bull market, bear market, rally, is this. The way our models are positioned currently, we see significant risks to the market. We do believe, again, the way the models are positioned, that we could go back to the October lows and possibly reach new lows before this cycle is ended. So that's the monthly update. I thank you very much. I'll be doing another update in another month. I hope you join me for that. This is Rick Cortez. Thank you very much.